Your income can disappear by almost half before you even see it. Being your own boss means navigating complex self employment taxes. This is not just income tax, it includes two major components. Social Security and Medicare for 2024, the self employment tax rate stands at a hefty 15.3%. This breaks down to 12.4% for Social Security and 2.9% for Medicare. Social Security has an annual earnings limit of $168,600. Medicare tax, however, has no limit. It applies to all your net earnings from self employment. And there is an additional Medicare tax of 0.9% if your earnings exceed $200,000 individually or $250,000 jointly. This extra tax applies above these thresholds. It is a critical detail many new freelancers miss. You can deduct one half of your self employment taxes paid from your gross income. This small relief helps. You also need to pay estimated taxes quarterly. The four deadlines are generally April 15th, June 15th, September 15th, and January 15th of the next year. Calculating these estimated payments accurately is complex. You must predict your annual income and deductions to avoid underpayment. It is a tough guessing game. Missing these dates leads to significant penalties. Penalties can add a few $100s or even thousands. Imagine earning $60,000 and owing $20,000 in taxes and penalties. It is a harsh reality for many. Good record keeping is a strict necessity. Every business expense needs meticulous tracking. A home office deduction, for instance, requires specific rules. You must use a portion of your home exclusively for business. The simplified option lets you deduct $5 per square foot up to 300 square feet for a maximum of $1,500. The regular method is more complex, involving actual expenses like mortgage interest, utilities depreciation. Many self employed individuals also pay for their own health insurance. These premiums can sometimes be deducted if you are not eligible for an employer sponsored plan. Retirement contributions to a SEP IRA or solo 401k can significantly reduce your taxable income. A solo 401k allows contributions as both an employee and an employer. You might contribute up to $69,000 in 2024. That is a huge deduction. The qualified business income or QBI deduction allows many pass-through entities to deduct up to 20% of their qualified business income. This can be a huge tax saver, but it has income limitations and phase outs. For 2024, the QBI deduction begins to phase out for single filers with taxable income over $195,300 and completely phases out at $245,300. For married filing jointly, it phases out from $390,600 to $490,600. Understanding these thresholds is vital. If you operate as a sole proprietor or single member LLC, you are generally subject to self employment tax on all your net earnings. Switching to an S corporation structure might offer tax advantages. An S corp owner must pay themselves a reasonable salary, which is subject to payroll taxes, including Social Security and Medicare. Remaining profits can be distributed as dividends, not subject to self employment tax. This strategy requires careful planning and often involves higher administrative costs, like payroll services, corporate filings. For an S corp owner making $100,000, they might pay themselves a $60,000 salary. This $60,000 is subject to full payroll tax. The remaining $40,000 could be taken as a distribution, avoiding the 15.3% self employment tax on that portion. However, the IRS scrutinizes reasonable salary levels. Too low a salary can trigger an audit. The actual tax burden also depends on your total taxable income, placing you in different federal income tax brackets. For a single filer in 2024, the 22% bracket applies to income from $47,151 to $100,525. The 24% bracket goes up to $191,950. State income taxes add another layer of complexity. Some states, like Texas, Florida, or Washington, have no state income tax. Others, like California or New York, have very high rates. California's top rate can exceed 13%. New York's top rate reaches 10.9%. And then there are local taxes in some cities or counties. New York City, for example, has its own income tax. This adds another cost, often hundreds or thousands annually. The financial impact of these taxes means you must set aside a significant portion of your income. Many financial advisors recommend saving at least 25 to 35% of every payment for taxes. Some even suggest 40%, especially for high earners. If you are a freelancer earning $5,000 a month, that means 1,500 to 2,000 should immediately go into a separate tax savings account. Failing to do this causes immense stress and ruin. Imagine needing to pay $10,000 but only having 2,000 saved. It forces painful choices. The administrative burden also cannot be overstated. Keeping receipts, categorizing expenses, and staying abreast of changing tax laws takes considerable time. Time not spent on billable work. Many self employed individuals work extra hours just to manage tax compliance. This unseen labor cost is high. Hiring a professional tax preparer or accountant is often essential, but that comes with its own fee. An accountant might charge $500 to $2,000 depending on business complexity. This is another direct cost to factor in. Business vehicle expenses, mileage deductions for client visits, or supply runs are important. For 2024, the standard mileage rate is 67 cents per mile. If you drive 10,000 business miles, that is $6,700 in deductions. But you must keep a detailed mileage log. Without it, the IRS disallows the deduction. Startup costs are an example. You can deduct up to $5,000 in business startup costs and $5,000 in organizational costs in the year your business begins. Excess must be amortized over 180 months. This small deduction helps reduce early taxable income. Also, consider the health savings account, or HSA. If you have a high deductible health plan, you can contribute to an HSA. Contributions are tax deductible, earnings grow tax free, withdrawals for medical expenses are tax free. For 2024, the individual contribution limit is $4,150. For families, it is $8,300. An HSA is a powerful triple tax advantage vehicle often overlooked by the self employed. It is not just about the rates, it is about the volume of taxes, the frequency of payments, and the sheer amount of documentation required. It demands meticulous financial discipline. You are not just a boss, you are also your own payroll department, your own accountant, and your own tax compliance officer. All that work comes with a hidden price tag. It is a 24/7 job for entrepreneurs. It shapes financial decisions. You must always think about tax implications of every purchase, every sale. It is a constant mental burden. Many small business owners face penalties for the first few years as they learn the ropes. The learning curve is steep and expensive. They might underestimate income or overestimate deductions, leading to underpayment penalties. The IRS is not forgiving of ignorance. They expect compliance. Every dollar earned needs scrutiny for its tax impact. For example, if you buy a new laptop for business, that is a deductible expense, but if you use it for personal use too, you prorate the deduction. Such detail is expected. The average self employed individual spends an estimated 120 hours a year just on tax related tasks. That is 3 full work weeks. Imagine dedicating 3 weeks of your year solely to tax compliance. This is time not spent growing your business or with family. It is a direct opportunity cost. For many, it is overwhelming. Complexities grow with income and business structure. A sole proprietor S taxes are simpler than an S corp or partnership, but even a simple sole proprietorship needs careful attention. The stakes are high. Noncompliance can lead to audits, back taxes, interest, and penalties. These can financially cripple a budding business. Some small business owners end up owing tens of thousands. This often happens because they did not save or track expenses properly. It is a cycle of financial stress. Understanding these real costs saves heartache and money. It is the price of freedom, an expensive freedom. It requires a different mindset. You are collecting taxes for the government yourself. You are the middleman. You are responsible for getting it right. Many self employed people feel like they are working for the taxman first and themselves second. The first rule of being your own boss financially is always think taxes. It impacts net profit, cash flow, and reinvestment. It is a constant balancing act. Every quarter brings another tax payment deadline. Every year brings the annual tax return filing. It is an ongoing battle, but it is a battle you must win to truly succeed as your own boss. You must master the tax beast. General liability insurance for your business, for example, costs an average of $750 a year. Professional liability insurance can be $1,000 annually. These are business deductions reducing taxable income, but they are real money out of pocket. Business banking fees might add $200 a year. The cost of tax software like TurboTax Self-Employed can be $120 a year. Or maybe you pay for a subscription to QuickBooks Self-Employed for $20 a month or $240 a year. These are small amounts individually, but they add up to thousands. Your profit margin gets squeezed by these thousands of dollars. For many independent contractors, consistency of income is a huge challenge. One month you might make 8,000, the next month only 3,000. This makes predicting estimated taxes incredibly difficult. The IRS expects you to update your estimates throughout the year. If your actual income varies wildly, you must adjust your payments. Failure to do so leads to those penalties. This constant recalculation is a mental load. It makes budgeting tricky. You cannot just budget based on gross income. You must budget based on your after tax and after expense income. A significant portion of your earnings is inaccessible for personal use. It is earmarked for taxes or business operations. This distinction often surprises new entrepreneurs. They often spend gross income and find themselves short when tax payments are due. This leads to personal debt or scrambling for funds. It affects loan qualification because lenders look at net income after deductions and taxes. Reported income for a loan might be lower than gross revenue. A lender might consider only 40% of your gross income when evaluating your borrowing capacity. This could mean a big difference in how much house you can afford. That is another hidden cost of being your own boss. Professional advice from an enrolled agent or a CPA is highly recommended for self employment. It costs money, but can save much more in avoided penalties and optimized deductions. The average hourly rate for a CPA can be $200 to $400. Even a few hours of consultation can make a big difference. This proactive approach is essential. A common error involves failing to account for sales tax if you sell products or services. This can add an additional 5% to 10% burden. Missing this obligation results in further fines.